for CSL. CSL reported earnings this morning, and basically, to summarize, the key takeaway was that the first half of FY 2026, the performance was a little bit softer than what was expected. However, they are still maintaining their guidance for the whole of FY 26. And basically, the net profit dropped. There was a one-off extraordinary event where they wrote off about $1.1 billion of restructuring costs and impairments across the business. And that's really kind of what the market is looking at the moment. However, I think there's a big disconnect between where the price of CSL is trading at compared to what has come out, right? So this news is not unexpected, and it's been in the market for about a couple of months. Um, and basically, we've seen CSL fall from about $300 to about $150 this morning when it opened trading. In terms of revenue, they reported about $8.3 billion, down about 4%. But their cash flow will still remain strong, and they are going to pay out an interim dividend of $1.33. Um, but I think the key thing is that they are looking to maintain their guidance on profits in the second half of the year. So hoping to do a little bit catch up. For the division breakdown, CSL has three main divisions: the Bearing business unit, Seqrius, and Vifor. Now, in terms of Seqrius, it's been expected that with the vaccine segment of the business, it's going to be a little bit softer, obviously, after COVID and the lower immunization rate in the US. But I think the underperformance was in the Bearings business unit for their hemoglobins and iron deficiency products. It was slightly softer, it was about 6% softer than what it was in the previous half of the year. And that was mainly due to US Medicare reforms. And we did see a little bit of softening in some of the other products due to some policy changes in China. I think the other big piece of news that came out was basically the CEO retired yesterday, the previous CEO, Paul McKenzie, and the new interim CEO to replace him is Gordon Naylor. Um, and I think the market's really taken negatively to these two announcements today and yesterday. However, given where the valuation is at the moment, they're really net debt to EBITDA, it's still only at about 2%. Their cash position is strong. They are expecting a stronger second half. It really represents a good opportunity to buy, I think, at the moment, because a year or 2 years ago, CSL trading at $300, it was very, very fairly priced, and there was a lot of growth priced into that stock. But at the moment, really, I think it's definitely undervalued, given where the performance is. Obviously, a lot of that premium in terms of the future growth has been taken out, and they are in a phase of restructuring. So, you know, it's uh, it's definitely a year of reconsolidation for the business. But they are doing more, increasing their buyback from 500 million to about 750 million. So I think the management sees strength in it, and it's such an established business. I think it will continue to do well in the future. But definitely, it's going to be a tough year. However, we are seeing value in this stock. So if you don't have the stock, definitely add. And as you know, it's one of the biggest stocks on the ASX that's historically done incredibly well. Um, yeah, so for us, and add to see